Hi, everyone. Welcome to the channel. Our goal here is to take complex financial topics and break them down into easy to understand bits and pieces. Today, we're going to talk about an important topic that impacts many families. What happens when the second generation receives an inheritance? If you're expecting an inheritance or just want to understand the process better, stick around. This is some pretty crucial information. So let's give a general overview of the process. When someone passes away and leaves an inheritance to their heirs, the transfer of assets typically goes through a legal process known as probate. For most families, this marks the beginning of dealing with the estate. Here's how it generally works. First, there's got to be an inventory of the estate. The executor, a person named in the will or appointed by the courts, takes stock of all the deceased assets and liabilities. Next, they have to settle any debts. Any outstanding debts, taxes, or expenses are paid out of the estate. Third, they have to distribute the assets. Once the debts and the taxes are settled, the remaining assets are distributed according to the will. If there's no will, then the state intestate laws determine who gets what. Now, let's dig deeper into probate, what it covers and what is excluded. So, what is probate? Probate is a court-supervised process to settle the deceased person's estate. Its primary goals are to ensure the will is valid, settle outstanding debts, and distribute the assets to the rightful heirs. While probate serves an important purpose, it can be time-consuming and costly, sometimes taking months or even years to complete. So, what falls into probate? The assets that typically go through the probate process include individually owned bank accounts with no beneficiary designations, real estate held solely in the deceased name, personal property such as jewelry, vehicles, and collectibles, and investment accounts without named beneficiaries. Now, what is excluded from probate? Some assets bypass probate altogether, saving time and avoiding court involvement. And these include jointly owned property with rights of survivorship, retirement accounts, like a 401k or an IRA with the named beneficiaries that is not the estate, life insurance proceeds paid directly to beneficiaries, and payable on death or transfer on death accounts. So think like a bank account with a payable on death or a regular brokerage account with a TOD designation. As a financial planner, one of my jobs is to make sure any account or policy passes outside the process to make it simpler. Planning ahead can ensure more assets fall outside of probate, which can be a big help to your heirs and your executor. Now let's talk about some tax implications of an inheritance. This is where a lot of second generation recipients get hung up on, and it can be really complicated depending on what your situation is. So I'm going to break it down into 4 different categories. When the second generation inherits assets, it's essential to understand the tax implications. The 4 main categories of inherited funds include pre-tax, tax-free, taxable accounts, and life insurance proceeds. So let's break these down. Pre-tax assets. These include traditional retirement accounts like 401ks or traditional IRAs. Since contributions were tax deductible, and taxes were deferred during the original owner's lifetime, that means the funds have never been taxed before. These beneficiaries must pay tax on any withdrawals, and it's taxed at their ordinary income rate. The new rules under the Secure Act often require heirs to withdraw the entire balance within 10 years of an inheritance. So if you inherit a pre-tax account, it's really important to strategize withdrawals to minimize the tax impact. Depending on your income tax rate, it may be beneficial to draw the RMDs out over the full 10 years or accelerate distributions if your tax rate is lower than normal. So that brings us to our next category, tax-free assets. Roth accounts, such as a Roth IRA or Roth 401ks, offer a significant tax advantage. Since contributions were made with after-tax dollars, qualified withdrawals are tax-free for the beneficiary. However, like pre-tax account, the Secure Act often requires beneficiaries to withdraw the full balance within 10 years. Now, depending on your specific circumstances, one strategy may be to let the Roth funds grow tax-free for that entire 10-year period before withdrawing, maximizing the tax-free benefit. Now, the next type of account would be taxable accounts. These are accounts like brokerage or investment accounts funded with after-tax dollars. Taxable accounts are taxed differently than pre-tax accounts and subject to a more favorable tax rate, assuming the assets were held for more than a year. The more favorable tax rate is called a long-term capital gains rate. Now, I want to go over an important feature of taxable accounts. Taxable accounts are subject to what is called a step-up in basis upon the account owner's death. This means the cost basis of the asset is adjusted to the market value on the date of death. Now, what this means for the second generation is there can be little to no tax obligation if they decide to liquidate the funds shortly after the owner's death. Now, the last type of account that I'm going to go over are life insurance proceeds. Life insurance payouts are generally tax-free to the beneficiaries. However, if the estate's value exceed the federal estate tax exemption, estate taxes could apply before the distribution. So work with your tax advisor if you're inheriting from a high net worth estate to understand the potential tax implications. So inheritance can bring financial opportunities, but also comes with complexities. Understanding the probate process, what's included and excluded, and the tax implications of different asset types is critical for making informed decisions. Now, if you found this video helpful, don't forget to like, subscribe, and share with someone who might benefit. And as always, consult a financial advisor or an estate planning attorney to ensure you're navigating your inheritance in the best possible way. Thanks for watching, and see you next time.